The Money Show.
Personal Finance with Warren Ingram.
25 minutes to 8 the time. Warren Ingram's the certified financial planner at Galileo Capital. And tonight we're talking about why you can't avoid the scary moments in the markets. A scary headline can sometimes, in a way, kind of be the market's best day. Warren, good evening. So there have been plenty of scary moments over the last 5 years, and it's so tempting to get out of the markets. Tonight we're talking about the actual intricacies of this and why you can't do that.
Absolutely, and I think it's such a human emotion, and often, when our lives are threatened, it's a very good strategy, to avoid danger and get yourself, to a place of safety when you can, and that's a great way to survive. But in the investment world, that urge, and it's pretty primal, it's part of our lizard brain, is often the kind of drive that forces us to make decisions that actually act against our best interests, and something that I think we just need to pay attention to, and pretty apt time to talk about it because the world's in a scary place again, and both from geopolitics, markets, and the like. And I suspect that lots of people are feeling a bit unsettled, and so it's a good time to remind them that maybe it's time to embrace that sort of sense of fear and fight the lizard brain.
Okay, if you're wondering why we need to fight the lizard brain, why we need to stay invested, 011 883 0702 021 446 0567, and voice notes, of course, please, on 072 702 1702. Okay, so a part of this is about trying to time the market. You can see that bad things are happening. You want to keep your money safe somewhere, and then when it starts to rise, you want to buy back. Why is that so difficult?
You're forced to make quite a few decisions when you think you might just be making one. So the first decision, which is maybe the most obvious, is you decide to buy an investment, and you make your call, and it's a good decision, it's rational, everything's going well, and then life is trundling along, your investment's growing, and then all of a sudden the world gets a bit scary, and you look around and you go, hang on, this is not so fun. Maybe what I need to do is sell my investment now, and although I'm happy with it normally, I just shouldn't buy it or own it right now, and I'll sell it, and I'll wait for the inevitable to happen, the bad news to happen. Things will fall. The investment I want, that I currently own, it will then drop, and I'll buy it again, and then it will rise again. So the theory around that is pretty intuitive. It's something we all understand. The reality is much different because what happens is you've got to make three almost perfect decisions just to try and get one thing right. The first is you've got to buy a quality investment at a low price, and you've got to let that grow so that you make money. But now you decide, well, hang on, this quality investment might fall. So you've got to sell it before the crash. So that's the first decision you have to get absolutely right. And then you've got to hope that when it falls, you're fast enough to buy it before it recovers again. And so now you've got to get two decisions perfect in a row. And history shows that it's a very nice concept on paper, works perfectly in every textbook ever written, but in the real world with real money, almost nobody gets it right. And if they get it right once, let's say some famous trader gets it right in 2008, the next big event, when you think they know how to do this, you realize they don't, they get it wrong. So what happens is we put the experts on a pedestal and failing to understand that they were simply lucky the first time around.
Okay. And then the other thing is that you don't know when the biggest up day will be and the biggest down day will be. But if you just look at the JSE over the course of a week and look at the biggest rises and falls over the course of a week, those days are often very close to each other. They actually happen in the same period sometimes.
Yeah, so it's astonishing research. Often you'd think, well, the really good days in the market, and to give it context, a really good day would be when the market jumps by more than 5%. That's an astounding day, and sometimes it'll go up by 9 or 10%. And you would think that those are the days that happen when the world is incredibly positive, when people are just so happy and economies are booming, interest rates and inflation are low, and we're all just monumentally positive, and then we get an astoundingly good day. That's not true. what generally happens is the best days in the market, when you get a 9% or a 10% jump, happen after the market's been absolutely smacked and people are desperately fearful. The headlines are blood on the streets or something, equally dramatic. And then all of a sudden, a bunch of investors almost randomly look around and say, well, hang on, there's some really quality things out there that are trading at almost no price. They're incredibly cheap. I'm going to buy. And then you get one of the best days in the market. And the problem is you need to be in the market on those days. And the only way you do that is to embrace, those lousy headlines.
Okay. I mean, obviously you want to miss the bad days. What happens if you miss a few days? I mean, I presume there must be consequences to that. You could miss just a handful of days. What would happen?
So let's talk about missing the best days. So now we've established that those best days happen in really bad times when everybody's really scared. Now, over a 20-year period, and 20 years, is roughly 5,000 days. So it's quite a few days. If you miss the 10 best days out of that 20-year period, your returns generally are about half of what they would be if you just bought the investment. So let's just say we talk about the index. You buy the index, you do nothing, and you invest your money. Let's say it's 10,000 rand. You put 10,000 rand in the index, and you let it ride for 20 years. So there's lots of crashes and booms and all sorts of scary headlines all along the way, but you do nothing. Your 10,000 rand after 20 years will give you round about 65,000 rand. So nice return. You did no work. You didn't have to trade or make any decisions, but you missed the 10 best days in that 20-year period. Your return's going to be about 32,000 rand. So not even half. And just think about that. How is it possible to be so accurate that you're going to get 10 out of 5,000 days? So the answer is you can't. And now you've halved your return. So you have to embrace I guess that's the message I'm really trying to land, is about the best days are amazing days to be invested. The problem is they happen when things are really not going well everywhere, and everybody's shouting at you, from the media to your friends to your stockbroker, everybody. Your mother-in-law is even telling you that things are going bad. Your hairdresser is telling you it's time to get out. And then the best days happen, and you've got to be in them to get that return of the 65,000 and not the 32,000.
So, I mean, just in a calculation of 5,000 days and 10 days, I mean, you're just not going to get that right. No one in the world's going to get that right. That's why trading is so interesting, I suppose, is because it's impossible to get that right.
Yeah, and I think a lot of people would now say, well, hang on, I'll just create an AI bot and it will do it for me. The difficulty you've got is that eventually, unless all markets are only run by trading bots, if there are humans involved, you have to account for the irrationality of the crowds, the madness of the crowds. And that's the thing you can't calculate. So that's the problem with investing, is it is going to be irrational in the short term. And how on earth are you going to get 10 days out of 5,000 right? How are you going to predict that? And I just don't think it's possible.
Okay. I mean, I'm fascinated by the fact that the bad days and the good days happen so close together. But I suppose if you think of some of the more frightening things we've seen, there's probably an important reason why that happens.
Yeah, and so one of the ways to kind of turn this on this head, which is what some people would do, is say, okay, well, hang on, why don't I just develop a strategy rather than, instead of trying to aim for the best days? You've just said that that's really not possible. And maybe someone buys that point. Why don't I then just kind of avoid the worst days? Now your problem is that the worst days are almost side by side with the best days. So when you're in, like, I think a great example is the COVID crash. It's something that was entirely a shock to the system. It wasn't driven by inflation. It wasn't driven by overvaluations. It was a pandemic that just flooded the world at really short notice. And markets, fell incredibly quickly. And so you can't just avoid the bad days, because they are going to be a surprise. I know we had this conversation early in the year about valuations, and you could say, well, hang on, sometimes, we know bad days are coming because valuations in markets are high, and that's a more predictable kind of a thing. Okay, but you can't forecast a pandemic. You can't forecast a big war or a terrorist event or something that causes huge market events. And so you can't, unfortunately, avoid all the worst days either. And then remember that, when the worst days happen, they're right next door. Almost, if they were kind of people, neighbors, they would probably rock up at the same party. They are just hand in glove together.
Okay, so if you look at what happened during COVID, everything fell and everything jumped all at the same time, and that's just the way it goes. So then what do you need to do yourself? So markets will be falling. You will start to worry about that. Everyone will be saying, your spouse who you share your money with will be saying, get the money out. What are we going to do? How do you manage that?
I think firstly, understand it before you allocate money to investment markets. So you've got to know that volatility, which is just a fancy word, or a fancy way of kind of saying the roller coaster ride. It's a condition of markets. You can't get opportunities for investors to buy things at a good price, especially quality investments, if there isn't volatility. If everything's stable and predictable, then you're not going to be able to make good capital growth over long periods of time. So embrace the volatility before you invest the money. If you're investing as a couple, as a team, look each other in the eye and say, we do this and we don't sell when the news headlines are scary. We're going to remember this thing of 10 days out of 5,000, and so prepare yourself for that and say, okay, the deal here is, my job as an investor is choose quality investments and then stay the course, stay invested. And most especially, if the markets do have a big hiding, and you're a monthly contributor, you do a debit order into your investments, or you invest every 6 months, or whatever the deal is, whatever your pattern is for investing, keep going. What you need to make peace with is that what you're probably doing is buying a very high quality investment, and it's now a third of the price of what it was a little while ago. So don't now get suckered into the headline fear and say, well, hang on, maybe I'll just stall the new investments and I'll wait till things get better. You actually, the headlines are giving you the opportunity to buy fantastic investments at the moment when everyone else is selling, which means you're getting the deal. And that's why, I always think, when we talk about things like tax-free savings accounts, unit trusts and retirement funds, the discussion is always, these are long-term investments. So understand that long-term investments are designed for decades of growth. That's how you compound. You've got to allow the money to work for you, and that means you look at volatility, and if you're a saver and an investor, you should kind of be smiling a little bit to say, okay, there's volatility, there's a lot of noise and a lot of fear on the streets. What I'm going to do is I'm going to try and become a buyer of everyone else's panic selling, and I benefit when I look back in 5, 10, and 20 years' time. But what I shouldn't do is fall victim to all of the fear mongering that causes me to sell the quality thing at the wrong time.
And I suppose if you stay in over a long period of time, you're the ones who create wealth because you've kept the money in one place.
Yeah, and I think it's that, go back to do you want the 32,000 or the 65,000 over exactly the same amount of time with exactly the same amount of money invested? And so, we kind of know it as an academic concept that, that people, when you put them in a large group, and the largest group I can find is the stock market. People tend to behave badly. They don't behave rationally, etc. So rather than fall, fear of or fall foul of that madness of crowds, say to yourself, I'm the exception. The superpower I've got is I can't be cleverer than everybody else. I can't second guess all the big financial institutions and fund managers and buy better investments than they can. But what I can do is buy quality investments, potentially the same ones that they've bought. But I can stay invested when they fall subject to the panic, and I can carry on because I've got a game plan, and I can do that without having to worry about everybody else. And that's the secret to building real wealth, is not running for the exit when everyone else does. In fact, you should be running into the madness to keep buying.
Sure. I've got an email earlier today from Colleen. Colleen emailed me at Stephen@702, and she said, "Dear Stephen and Warren, I have learned so much from your show. I'm pleased to say I now save every month, and I understand quite well how to increase my tax efficiency. I suspect my question does not have one simple answer, but I'd love some guidelines. I do my best to maximize my RA contributions each year on an investment platform. The problem, however, is that there isn't just one product to choose from. There are interest and money market funds, balanced funds, all the way to pretty much all equity. Similarly, some are more offshore than others. I can see there are limits, for example, to how much equity one can have and how much offshore, etc., but those are just the upper limits. I'm not sure exactly where one should be relative to those limits. I was wondering, is there some guideline as to a kind of percentage breakdown we should aim for? If it helps, says Colleen, I'm about 8 years off retirement age. Colleen's great question. Thank you for emailing me. We'll have an answer for you from Warren in just a moment. Warren Ingram, of course, with us in Personal Finance. Colleen's question, Warren, trying to maximize my RA contributions, their interest in money market funds, balanced funds, all equity. Some are more offshore than others. I'm not sure where one should be relative to the limits. Is there some guideline, a kind of percentage breakdown we should aim for? She's 8 years off retirement age. Warren, please, some wisdom for Colleen.
I love the question. So I think the one key piece of information here is the 8 years, because let's just say Colleen doesn't specify, but let's assume Colleen's going to turn 65 in 8 years' time. That's already getting into long term, and that's important because when you've got 8 or 10 or 15 years to invest your money, and why I'm mentioning longer than 8 years is because Colleen's not dying in 8 years' time; she's just retiring. Her money still needs to keep working so that it can provide her an income for her whole retirement, and so her time horizon's probably at least 8 years plus, let's say another 30. And in that instance, you should be looking at this and saying that's a long-term investment. And that means I need quite a big exposure to the stock market so that my money can grow faster than the inflation rate. So number one, you shouldn't really be looking at those lower risk investment options, let's say like the money market and the interest funds. Those have a different role to play. They're great for emergency funds. But when you're trying to grow your capital faster than inflation, you need a large exposure to shares. So you're looking at the category of unit trusts called balanced funds, and they're very good from the point of view that they'll often invest probably close to the maximum limit, somewhere around 75% in stock markets, and a lot of them would have somewhere around 30 to 45% in international markets as well. So you're getting a very good spread of local and global investments, and then a high exposure to shares, but they do balance it out with some exposure to the bond markets and some exposure to cash and maybe the odd property company as well. So I think that the guideline here would be, you've just got to be comfortable that a high exposure to shares means lots of volatility that we've spoken about on the show. But if you can deal with the volatility, you do get very good inflation protection from having that allocation to shares over a long period of time.
So, I mean, it's just a reminder that volatility matters. Without volatility, you're not going to grow your investment. It's a key ingredient.
Yeah, I think we would all love stability. That's human nature to want calm and stable and safe, and that's great when you're building a house, for example, or a good ship. But what you don't want to do is have a very safe, stable investment, because what it's guaranteeing you is that it will probably perform just below the inflation rate, which means your money doesn't grow faster than your cost of living. And so you have to deal with that volatility and almost take comfort that if you've got volatility, you've got a chance of doing better than inflation. And that's really the enemy you want to fight when you're dealing with your retirement capital.
Okay, so we were talking about what to do on the scary days, and a sort of endpoint on it was the people who create the wealth are the ones who are able to sort of stay invested in the same thing for a very long time. But there are moments, and Warren, I mean, I agree with you. I think there will be moments fairly soon where you sort of look at it and you go, gosh, I think I need to do something. I can't stay like this. So then what should we do?
The first thing is maybe just take a break from kind of your media consumption, especially like the social media engine that's feeding your fear, and just set that aside for a second. if you can, kind of have a conversation with people that you, or a person or some people that you respect who have a kind of fairly calm head and fairly clear-headed and clear thinking and rational, and then go and look at your investments that you have got invested and just make sure that these are investments that you can leave in their respective portfolios for that period of 5 or 10 years, and then ask yourself the question: if I've got 5 or 10 years, let's say it's 10 years, I've got 10 years to invest, and my portfolio goes down by 30% in the next week. 30% is a radical drop, but if it does and it recovers by that 30%, in 2 years' time, what's really changed in my life? And if the answer is nothing, then leave the investments as they are and let them be, let them do their job. But if you're going to need the money in a year's time, then it shouldn't be in the market anyway. You should start changing that and putting it into money market accounts or something. So I would say that that's the biggest thing you should do. And then if you are doing debit orders, keep the debit orders going when things get scary and take advantage of the sale that's on offer when it happens.
And if you feel the urge to sell everything, do you need to just count to 10 and listen to Warren?
Yep. Please go and get a recording of this show and play it to yourself again, because doing nothing, it seems like a lazy thing to do when you're building a house, but often doing nothing when you're investing is probably the best thing you could possibly do, and it's an intelligent thing to do and very hard for most people to actually action.
That's why we try to just cover our eyes sometimes, give it to someone else to manage. Warren Ingram, thanks so much. Really appreciate it. The financial advisor and co-founder of Galileo Capital. And of course, this will be put together as a podcast for you in probably about half an hour or so from now. I'm sure it will be available. But the lesson, of course, as always, is without the volatility, there won't be any growth in your investments. And if you don't have the growth, you won't be able to get an investment that returns higher than inflation. That's really, I suppose, the lesson from all of this.